All right, so 2025 was, well, it was a wild ride, right? And surprisingly profitable for a lot of folks. But now everyone's asking the big question: what's next? Where do we put our money in 2026? Today, we're jumping right into that huge debate: gold versus stocks.
So yeah, where is the smart money going? Are we talking about the old reliable, the safety of gold? Or are we betting on the stock market, that powerful engine for growth? After a year that pretty much threw all the rules out the window, this is a tougher call than it's ever been. And hey, if you want to know why this debate is so hot right now, just look at this number: 100%. That was gold's return in just 1 year. I mean, that's not just good, it's absolutely staggering. It blew past most of the big stock indexes, and that, my friends, is why everyone is paying attention now. Okay, so how do we even start to make sense of all this? Well, according to the experts, there are two big themes that are going to shape the year ahead: resilience and rebalancing. Think of these as our two guideposts for this whole discussion. Last year, 2025, it was just a total puzzle, wasn't it? There was so much uncertainty floating around, but at the same time, the markets just kept climbing. Turns out businesses and regular people were just holding on to their cash, and now that cash could be ready to fuel some serious growth in 2026. It's this weird mix of being cautious but also seeing a ton of opportunity on the horizon. So, what are we really talking about with these two words? Well, resilience, that's just a fancy way of saying how well the economy has managed to take a punch and keep on ticking. But rebalancing? That's the one you, as an investor, really need to pay attention to. It's all about starting to look for opportunities beyond the usual suspects, the big US tech stocks that have been leading the charge for so long. And that idea of looking for new opportunities brings us right to the main event. It's that classic showdown, right? Safety versus growth. Let's really break down how gold and stocks are stacking up as we head into 2026. This slide just lays it out so perfectly. On one side, you've got gold. We call it the safe haven for a reason. Its job is to protect your wealth when things get crazy. And on the other side, stocks, the wealth creator. Their whole purpose is to tap into business growth and, well, multiply your money over time. Two totally different jobs for two totally different goals. And this chart, wow, it shows you just how massive that performance gap has been. Let's put it in real terms. Say you put 10 grand into silver a year ago. Today, you'd have more than $38,000. No joke. If you put it in gold, you'd have doubled your money to 20,000. Meanwhile, that same 10 grand in the S&P 500, it would be worth about 11,500. I mean, the difference is just incredible. Let's dig in a little deeper here. This table really clears things up. See, gold is all about protection and stability, lower risk, and its returns have historically kind of just kept pace with inflation. Stocks, that's your growth play. Higher risk for sure, but also much higher potential returns. We're talking 12, 15%, or even more. And here's a huge difference. Stocks can pay you dividends, an actual income stream. Gold, it just sits there. Its only value comes when you sell it for a higher price. And look, the case for gold isn't just wishful thinking. It's got some heavy hitters behind it. Mohammed El-Arian, one of the top economic minds out there, is actually predicting gold could hit $6,000 in 2026. Now, he does say it's going to be a bumpy ride to get there, but still, that's a huge potential upside. All right, so the gold versus stocks debate is pretty clear, right? But hold on. Remember that other theme we talked about, rebalancing? Well, the story for 2026 is actually a whole lot bigger than just these two. So where else are the experts looking for opportunities? Turns out the opportunities are literally all over the globe. People are getting really interested in stocks in Europe and Japan, which look a lot more reasonably priced than the US market right now. And of course, emerging markets, especially with China expected to have a strong year. But it's not just stocks. Analysts are also pointing to things like industrial metals, crypto, and even something called private credit, which is basically becoming the bank and lending directly to companies. Lots of ways to diversify here. And you can really see that shift in thinking right here. For what feels like forever, the only story that mattered was the US market. But things are changing. Prices are high in the US, and now, with a weaker dollar and other governments stepping in with support, places like China are starting to look really attractive. This, right here, is rebalancing in action. But of course, no forecast ever comes with a guarantee, right? Every optimistic outlook has its wild cards, those what-ifs that could flip the whole script. So let's be smart about this and look at the biggest risks on the radar for 2026. Okay, there are three big what ifs we really need to keep an eye on. First, what if there's a global recession instead of a recovery? If that happens, you'd expect those classic safe havens, bonds, the US dollar, and, yep, gold, to hold it pretty well. Second, what if inflation comes roaring back? That would really hurt smaller companies and emerging markets. And finally, what if there's political instability over in Europe? That could seriously mess with their growth, hitting their stocks and the euro. So, we've looked at the big debate, we've explored the global opportunities, and we've talked about the risks. What does this all mean for you? How do we pull this all together into a game plan? Let's build a simple, actionable playbook for 2026. So here it is, the single most important rule, and maybe it's the golden rule, literally. You don't have to choose. The number one piece of advice from pretty much every expert is to diversify. This isn't about picking one winner and hoping for the best. It's about building a balanced portfolio that can handle whatever comes its way. And let's get really practical with that advice. How much of that safety net do you actually need? Well, the general consensus from experts is somewhere in the ballpark of 10 to 15% of your portfolio in gold. That seems to be the sweet spot, enough to give you a real cushion if things go sideways, but not so much that it'll hold back your long-term growth.
So, it all comes together in this simple three-part strategy. Step 1. You need your growth core. Keep the bulk of your money in stocks and other assets designed for long-term growth. Step 2. Build your safety net. That's where that 10 to 15% in gold comes in, to protect you from volatility. And step 3. Be a global explorer. Look beyond the US and find those rebalancing opportunities in international markets and other alternatives. And that really brings us to the final question you should be asking yourself. Your portfolio probably made it through the roller coaster of 2025, but is it really ready for 2026? Is it truly set up for a world that's all about resilience and rebalancing? Definitely something to think about.